We came into 25 with very high expectations for the M&A market. So I think the bullishness that we came into the year with has not necessarily seen reflected in Q1 as much as we would have liked, but we're still expecting a relatively strong year.
There was a lot of optimism with the thought that we could see change at the FTC and the SEC and in the DOJ antitrust division. We have not seen that open the floodgates for M&A activity yet. It seems that businesses are still somewhat on the sidelines, thinking about what could happen with tariffs and the uncertainty related to tariffs. People were expecting higher deal volumes to happen in the early part of 2025. We have not seen that yet come to pass. We're still at fairly close to 2024 levels. Just to give you a point of comparison, in 2021, deal volumes as a percent of GDP were at 10.6%. It was anticipated that we would start to see an uptick again. That unfortunately has not happened as of yet, but there are some macroeconomic fundamentals in place that could release some of that M&A activity.
I think private equity firms certainly have a tremendous amount of capital that they would like to invest. So the dry powder on private equity is over $2 trillion, which is a significant amount of money they'd like to invest. They also hold a lot of portfolio companies that they would like to divest that have been bought over the last several years. And so there's tremendous pressure on private equity, I think, to transact on both the buy and the sell side. We did see that 58% of businesses expressed an interest in doing more foreign acquisitions. What's interesting about that, as we've gotten into 25, certainly there have been more headwinds created through certain of the current environment, including the tariff situations that have made those deals a little bit more complex to contemplate.
The market was very much surprised with not only the scale of the tariffs, the rates were much higher than many people anticipated. Businesses are going to be significantly impacted depending on how they have to deal with those higher import prices. Their outlook for growth forecasts, of course, will be negatively impacted by that, which then would impact their ability to undertake M&A.
The biggest increase where we've seen in M&A activity in this year so far are sectors like infrastructure, where we've seen a continued expectation of deploying a lot of capital into the infrastructure markets, including data centers. We've seen life sciences and healthcare continue to be extremely active in the market. We've seen a little bit of a resurgence more recently in the technology sector, and so we expect some of those trends to continue. We've seen more challenges in some of the supply chain heavy sectors where the impact of some of the tariffs and other things are harder to predict.
But it's yet to be seen what the cost of capital is going to look like for those types of transactions. If the Fed decides to ease, we could potentially see lower rates, which would help with cost of capital, bringing that down. But there's also a scenario that may come to pass that the Fed will have to increase rates, for example, to speed up the economy. I don't think it's written in stone yet that we're going to see a significant slowdown. There is certainly a base case where we continue to see somewhat sluggish growth. You could see growth in the 0 to 2% range in terms of real GDP. Stagflation is certainly on the table, which has not been on the table for a very long time. This would not bode well for the M&A market.
If rates are expected to increase, that makes it harder to get deals done. Those risks are there, but we believe longer term, there will be still some tailwinds created from a potentially relaxed regulatory environment.